All right. Hello, everybody, and welcome to SEDC's webinar series. I'm Holly Hart, an associate here at SEDC, and I'm so excited that y'all are here for this presentation with Lucas Witt from MWM Consulting. So he's going to be sharing with us today about partnering with local developers for long-term economic growth. Um, we're going to have a question and answer session at the end. So if you want to save your questions at the end, type them in the chat. We'll have that little time at the end, and I'll hand it over to Lucas to start. So thank you for being here.
All right. Well, good afternoon. Thank you to everybody for joining. Everyone has plenty of things to do with their day, and we appreciate you taking time to spend a little bit with us. So I'll dive right in and give brief background on myself and our firm. As Holly mentioned, my name is Lucas Witt. Our firm, MWM Consulting, we're based out of Lexington, Kentucky, and we specialize in economic development and real estate advisory. We somewhat use a tagline that we say quite often that we, through our work, attempt to bridge the gap between public sector planning and private sector implementation. What does that mean? In most of the projects that we work, not every single one of them is public related. Sometimes we're just working with corporate entities and sometimes just with public entities. But in a lot of cases, we are attempting to work with public organizations to help them better align with corporate clients, and specifically economic development projects that have a need within the commercial real estate world. Everyone on our team here at MWM is also a licensed commercial real estate advisor here in the state of Kentucky. And our firm is built uniquely with an affiliation with a full-blown commercial real estate brokerage firm that would do all the things that you would imagine in terms of commercial real estate. Our team at MWM, though, is heavily focused on economic development with, like I said, a focus in the real estate advisory world. So we tend to find ourselves in community projects and public projects that have a focus in the economic development plus the real estate world. So that could mean helping communities identify new land for their industrial park. Why should they be buying this land? Are they better suited for automotive, better suited for aerospace, plastics, metals? And we use that data to help them be successful in playing in the real estate world. So today, in terms of what we are going to be talking about, partnering with local developers, and hopefully put a positive spin on it. I want to voice, right now and also frequently throughout the presentation that this certainly isn't a one size fits all approach. I don't think there's a single approach, in our industry that is relevant to every single project. Every community is unique. Every piece of property is unique. With that said, though, we've seen, in many cases, we've had the ability to work across most of Kentucky now, and then also beginning to work in surrounding states. And we've seen in many cases, communities hold on to vacant pieces of land and it just sitting vacant. And in some cases, they've denied a partnership with a local developer. And in some cases, right, wrong, or indifferent, so they didn't lose control of who the end user was. And we certainly understand the philosophy, and in some cases, it's a very relevant philosophy. We're here just to maybe provide a different perspective on why, in some cases, working with a local developer is a positive and a positive outcome for the land that the public entity owns. We're big believers in you do what you are best at. And when you start talking about public organizations, cities and counties, they are there to serve the citizens of that community, and that's in a lot of cases providing services to those communities. So when they're having to play developer as well as doing that, that's difficult in some cases. So with that being said, we're going to walk through some pros and some cons of working with a local developer, maybe some different strategies and ideas of how to better do that. And so I'll breeze through some of these topics here on this slide. So we're going to talk about each of them in more depth throughout the presentations. But so why do developers matter? In most cases, they have extreme market knowledge in the area that they're in. They are playing the developer role every single day. They have a really good understanding of the market, right? Every single community, depending on the size, depending on location, in terms of the demand of the product in their area is going to vary, right? And in some cases, it might not all be industrial. It might be more heavily focused in commercial. They're going to have a really good understanding of the market, probably more so than those who are running cities and counties because they're busy running cities and counties, right? Uh, Furthermore, shared goals. I think this is where the relationships collide in a lot of cases. Again, we're not developers at my firm, so it's no skin off my back of what the reputations of some developers are. In some cases, they're good. In some cases, they're bad. But I do think in a lot of cases, they get a bad rep, maybe sometimes justified, sometimes not. But I do think their goals are more aligned with communities than sometimes they're giving credit for, right? If they go out and they build a successful product, a successful commercial development, an industrial development, that's likely going to lead to increased economic development activity for that area, which is then going to lead to increased tax revenue for that community, who then can provide increased services and improve services to their citizens of the community. There's also a strategic advantage of partnering with local developers simply because they're experts in their field. Again, whether that be industrial, commercial, or retail, whatever that might be, healthcare, they're experts in their field and they do it every single day. They understand the regulatory process of getting from a shovel in the ground to getting a certificate of occupancy. In the economic development world, we're all about announcements, right? We want the big announcements of the $100 million project that's going to generate hundreds of jobs. I think in a lot of cases, the public specifically, not people on this call because you're in the industry, but the public loses sight of after that announcement, the real work begins, and getting to a certificate of occupancy is really hard. Well, developers understand that, and I think that adds value to certain projects. Um, Furthermore, obviously, developers play a key role in creating a long-term vision for their project. I think in a lot of cases, people forget that developers usually don't make money while they're building, a $50 million development. They're not going to make money until the back end once the buildings are either sold or leased that they built, or they sold the development as a whole. So they have to think long term. Usually, developments are momentum builders. We always say construction tends to breed more construction, and in a big vacant, industrial park, if you've got 300 acres of land, on the front part of that park, selling off a portion to create some momentum isn't always a bad play. And then diversification. This is probably the focal point of what I'll talk about today. Having both land and existing buildings to market to prospective companies is going to give you more opportunities at the plate. So, I refer economic development to, I was a baseball player growing up, to the game of baseball. You are going to fail far more than you succeed in economic development. I think everyone knows that you're going to respond to a significant amount of RFIs and probably get told no more than you get told yes. So, at a minimum, your goal is to have as many opportunities at the plate as possible. And by having both existing land and then existing buildings within your portfolio, you're just going to have more opportunities at the plate. So moving forward, again, I want to continue to emphasize we are not advocating that if anybody's on this call is controls their land publicly, which you should, and we'll continue to speak on that, and you're specifically marketing it just within your local economic development organization. That is, we are not at all saying that's a bad thing. Again, we're just advocating that every single case is specific. So there's multiple ways to obviously market your property. What I just mentioned is one way. The public entity owns it, city, county, economic development authority, industrial development authority, and you're marketing that property, likely through the state database, your cabinet for economic development or your Department of Commerce. All of them have their own sites and buildings website, which at this point are really, really robust, right? Our argument is a bit more specific to the property itself and the characteristics of that property, right? In some cases, in Kentucky right now, the state's advertising that the average request that they're seeing across all the projects over the last 12 plus months is, call it 250 acres a project, right? That's a large project that's able to generate several 100,000 square feet of building and likely hundreds of employees. If we believe that if you really pull in more of the real estate data at a more micro level, the average project is actually much smaller than that, right? And if you look at properties that are, far less than 250 acres. For example, in Kentucky, there's a community just outside of Lexington, Kentucky, where the University of Kentucky is located. Woodford County, it's, you know, with being next to Lexington, it's essentially the horse capital of the country, right? It's where a lot of the Derby winners have come from and where a lot of them are, living for the rest of their life now. It's a really special community. A few years ago, they had a property in Midway, which is one of their cities, right off of I-64. You could throw a baseball from the interstate, or excuse me, from the industrial park and hit the interstate. I'm not exaggerating. It was right on the interstate, beautifully located. In total, it was probably 200 acres to start. And this was long before my time, 20, 30 years ago when they first bought the property. They probably took a bit of a risk, played a little bit of a developer too much. They built out road infrastructure throughout the park, and they kind of defined their lot lines, right? They defined them. They had some larger, they had some smaller, but they had a lot of smaller lots. And you fast forward, they had set vacant for a really, really, really long time. Luckily, a company by the name of Lakeshore Learning came in. They absorbed, kind of that larger 50, 70 acre parcel. They're now the largest employer in the community, but that still left them, 120-ish acres to sell that were smaller lots, right? 5 acres a pop, 10 acres a pop, 20 acres a pop. In some cases, because of utility easements, it was all the way down to 1 to 2 acres a pop. And those sizes of projects, I would argue 20 acres and below are typically not the ones that you see the economic development cabinets, at least on a frequent basis, working. That those aren't the projects that are typically being pulled from the Zoom prospectors and the state databases. Those are more of your everyday projects, but those are great, great projects. And the Economic Development Authority went through a revamp, and I'm certainly, we came on the back end when a real estate firm had already been hired to help. But once that firm came in, they were advertising the properties on more of the regional and national commercial MLSs, right? KCRA here in Kentucky, and then Crexy, LoopNet, and CoStar, and activity really picked up. Now, it was also when industrial was really, really heavy back in 2021, 2022. But those 5 acre parcels and 20 acre parcels, 10 acre parcels, 1 acre parcels, pricing on all those vary depending on size, infrastructure, how they lay. In at least just outside looking in, once that real estate advisor firm got involved, they sold it all, probably within a 2 year period, and now they have a thriving business park out there. Those 5 acre parcels generated, buildings in the neighborhood of 50, 60,000 square feet with 50, 60, 70, 80 employees. Great projects, right? Projects that are multi-million dollar projects that I think any of us would have been extremely excited to work. So again, that's just one example where working with, whether and they sold off a couple of parcels to developers who built spec buildings that were then leased to prospective companies, right? It was probably a more um, uh, anxiety driven way to go about it because you're losing control in some sense, but it then led, because of the type of property, it led to success. So that's all we're advocating here. Again, I want to continue to voice not a one size fit all type approach. Communities, we always advocate you need to own publicly controlled land. We all know how important that is. You need to play developer up to a certain point. You need to be able to get the infrastructure to the property line. You need to have the answers for how to increase the infrastructure. In some cases, you need to go after grant dollars to balance a site. Um, Drawing the line there, speculative buildings become a different, kind of a different game. So what is a developer? Let's just put it at its simplest form. A developer is someone who's willing to risk their capital to build buildings and infrastructure for future end users who then drive economic development opportunities. And when I say economic development opportunities, I want to continue to broaden that viewpoint. Our firm in the hundreds of millions and at this point billions of dollars of projects that we've worked has mainly heavily been industrial and manufacturing driven projects. But economic development is not only industrial, it's not only manufacturing. I think we all know that on this call. I think in a lot of cases, though, from a public perspective, they only see manufacturing, but that is not all that economic development is. Economic development is, that retail strip center that just got built down the road that has your mom and pop, you know, lunch spot and coffee shop, that's generating new revenue, that's generating new jobs. So every developer has a specific expertise that they focus in, right? There's a firm here in Lexington that really focuses in healthcare, and they've built a lot of the new regional hospitals around the state, which has led to a significant amount of economic development activity in those areas. So, what are the pros and cons and the advantages that developers bring to the table? Flexibility, they're typically more flexible probably than a governmental body simply because, as they should, your governmental body is adhering to, taxpayer dollars, and those taxpayer dollars are incredibly important. How they are spent, how they are budgeted, how they are allocated, and every dollar that's spent, technically on a speculative development is really scrutinized, right? The developers obviously have a bit more flexibility in that regard. They probably have a bit more flexibility and also their capital stack and their financing of how they pay for projects. I mentioned this earlier. They have a specialization of the type of product that they build. In a lot of cases, I think when communities have built speculative buildings, it wasn't maybe as clearly thought out as it should have been in terms of where they placed the building on the property. Did they leave enough room for the truck court and the truck radius? Did they put the dock doors and the driving doors in the right spot? Did they go ahead and finish the office build out or did they not? It'd be the equivalent of, just trying to, sell a house in an area that you're not from, right? How many beds is it? How many baths is it? What's the average price per square foot in that area? They are very specialized individuals and companies that build this product for a living. They also play a role in kind of activating a site, right? And once steel goes up, we always say that just breeds more interest and more and more construction, like I said earlier. And let's not kid ourselves, they are obviously ROI focused. You cannot argue that. There are private companies that are for profit, right? At the end of the day, they have to make money or they don't succeed. So, but in a lot of cases, we would argue that a project that generates a positive rate of return for a developer probably is also likely generating a positive rate of return for that community. If they build a good product with 100,000 square feet here and 50,000 square feet here and a larger box in the back, I understand in some cases maybe those don't generate the projects that we all want. Sometimes those end up being warehouse operations. I fully understand that. But I would think in a lot of cases, a positive ROI project for a developer turns into a positive ROI for a community with the new tax revenue that comes with it. So, you know, we would again argue that in more cases than not, a developer's successful project generates positive ROI for for a community. All right, now let's talk about some specifics that we've mentioned earlier. I think as important as anything, when you partner with a developer or when a community does, you're lessening your capital risk as a community organization, which is again equally as important as anything. I think it allows a community to be more strategic with the use of their funds. Again, I want to continue to advocate owning a site is really, really important in economic development from a public perspective. But when you're not going out and speculating on building actual physical product, you're able to be more strategic of where you use those public dollars. If that's for infrastructure build out, if that's for balancing the site, or is that for maybe leveraging specific tax incentives to get a deal done? It's allowing you to keep your money in an area where you're better served to use it. It's also allowing the developers to do what they're great at, which is when they raise private capital. In a lot of cases, some of these developers have raised significant amount of money that's sitting on the sideline ready to go. They're able to deploy that capital a lot quicker than maybe what a community is. Speed the market in the economic development business, we all know how important that is. We all win and lose projects based on being able to advise a company and end user that you've took out the risk for them. You can help them get up and going as quickly as possible. as we mentioned earlier, maybe one of the more strategic advantages of working with a developer is having both land and building to compete on projects. So in a perfect world, you have a larger site that's 300 acres, and you're able to retain most of the land for end users, right? And then you're able to sell off a portion of that land to a developer to build a product that's then going to allow you to compete for both new builds and also existing builds that companies need to move into. So just to provide some data as it relates to um, what the market's actively calling for right now. This is just in Kentucky, but I think it at least provides a perspective. Since January 2023 through April of 2025, there was about 1,400 property submissions from the state of Kentucky to prospective projects. That's hundreds of projects where, as you know, on each project they're submitting multiple properties. Of those submissions, about 60% were for greenfield projects and 40% were for existing buildings. So I think that's obviously very, very telling. 40% of the requests right now in Kentucky are very specific to an existing building. If you are in a community where an existing building is needed, but you only have publicly controlled land, you're obviously limiting your opportunities at the plate. And then again, from a real estate perspective, it's very specific to where you're located. Again, a lot of you probably know that, but when you take the data I just mentioned and you zero that in to a more localized area, the data starts to shift a little bit. So if you focus that data just on central Kentucky, right, during that same time period, the request for existing buildings went up. It was more like 45% were asking for existing buildings in central Kentucky. Why is that? Well, in a lot of cases, for example, central Kentucky, that's Lexington, right? That's where the University of Kentucky is. Land is very, very scarce in Lexington, and companies are forced to locate in existing buildings. So it's really, really important for that type of product to be available, depending on where you're located. All right. The funding capabilities, I think this is again, I don't want to, beat a dead horse here, but developers obviously have the ability to raise money, deploy money in a really quick fashion. From a community, perspective, in a lot of cases, counties, cities, EDAs, are having to bond money to do projects, which is a different level of complexity. It's very doable in a lot of cases, and in some cases, it's exactly what they should be doing. But again, from a funding perspective, a community is able to, or excuse me, a developer is able to act likely more quickly than a community is. They also are a bit more flexible. For example, a developer might have a 1031 exchange where they've sold a development in another state, right? And they're able to then deploy that capital in a new development in your state and also pair that with banking finance to do the project, right? They're able to raise private capital from institutions and endowments and high net worth individuals. They just have a lot more flexibility, obviously, and rightfully so. You wouldn't want your public entity being able to, raise and spend money like that for the right reasons. So again, from a funding perspective, they have the ability to do things that probably a community can't do. Then in terms of diversification of the product, I've talked about this a little bit, so I won't beat a dead horse there. You want to be able to provide both building and land options. I also think it's really important to point out, again, what I said earlier, do what you're best at. In some areas, economic development authorities and economic developers need to be spending as much time with their existing businesses as they are recruiting new businesses. The rate of success on a new project is incredibly low, right? It's likely in that 20% range across the region when you're competing for a new project if you're going to win it or not. If you look at announced projects in the state of Kentucky in the first quarter of 2025, 60% of the announced projects in Kentucky came from existing businesses. So those are companies who are already located in your area. By playing developer a little less and spending more time on nurturing the relationship with your existing businesses, that's likely going to lead to more announced projects, right? 40% obviously came from new business. In South Carolina, not to just harp on Kentucky the whole time, In the calendar year of 2024, they announced somewhere north of $8 billion of capital investment, and 65% of those announcements came from existing businesses. In North Carolina, a very similar uh, uh, um, data sets there. They announced, several $1 billion, and about 55% of that came from existing businesses. So I think the message there, which a lot of you probably already know, is the relationships with our existing businesses across your state are equally or more important than buying land, playing developer, and recruiting the new businesses. By allowing the developers to be who they are, it gives you more time to spend and nurture relationships with your existing businesses. So to try to wrap it all up in a bow here, when does it make sense to partner with a developer? What's the perfect scenario? I'm backing myself into a corner here because again, it's not a one size fits all approach, but specifically those that have larger parcels, 200, 300, 400 acres of land. Yeah, you bought that land for a reason, and probably because it's well located. You're able to get infrastructure there. You have a really good idea of the size of projects in your area. However, we're a big believer in leaving enough land for your anchor tenant, right? Your anchor end user. So, depending on where you are in that example, that might be, 200 acres in the back. That then allows you to have that more of a multi-user approach in the front, right? Where you're able to conceptualize, 5, 20, 30 acre lots and selling a few of those off to developers who then come out and speculative build buildings, right? We here on this slide we've said 20,000 to 200,000 square feet. There's no science behind that. It's just examples. And structuring those deals, I would argue that the hesitancy of striking a deal with the developer is you lose control of who that end user is, obviously, right? And that is a very justified worry. In some cases, when we've worked these deals, we've been able to structure agreements that states, one, you don't want to sell your land to somebody that's not going to do anything with it. You would have been better off keeping it, right? So you structure by what time do they have to start construction and be substantially complete, right? Or there's a penalty, right? That protects you in that regard. This is the harder one to structure, but you put a job creation threshold, especially if they're going to go out and lease the building or sell the building. Obviously, that's where the difficulty comes in. In the example that I'm about to show you, partnering with a local developer that you have a trusted relationship with, those are typically easier to pull off. But then the design flexibility, the design requirements, it depends on where you are, right? I think a lot of people would be shocked earlier this year at the Site Selectors Guild. I think that was back in, or excuse me, down at SC, not the guild, down at SEDC's event in April. There was many of the guild members who were there, and they were talking about the sizes of projects that they were working. Right, everyone's still chasing the mega projects, and that's great. But that mega trend has kind of come to a close now. And if you look at the building sizes that they're seeing most projects in, it's not the 500,000 square foot, 250,000 square foot buildings. It's more the 50 to 100,000 square foot buildings. And so, again, depending on where you are, the real estate data is very specific to your location in the state, where you have access to infrastructure and interstate capabilities, but allowing and requiring at least a minimum size of X square footage, because that's what the market's demanding, will give you a bit more, of that control that you're fearful of losing. And then at the end, again, hopefully you have a mutual benefit success. I think I've said this many a times now, but if they build a successful product, that's likely going to lead to a rate of return for the community that they can be pleased with. So I'm a big believer in case studies. I can talk about a lot of this. It's better and easier for you all or anybody to visualize what an end product looks like. So this is one that we're really familiar with. We've done some work in this area. And then if you're just traveling in Kentucky on I-65, it's really hard to miss at this point. So Franklin, Kentucky, which is Simpson County, it's just south of Bowling Green, Kentucky, and about 45 minutes north of Nashville. It's a town of 20, 30,000 people. So still a very small town, but they've done a really good job of making a use of their strategic location to Bowling Green and to Nashville, and to even to some of or a lot of the success that's going up in Elizabethtown, Kentucky, which is where the Ford battery plant is going. So on this slide here, you can see there's three separate industrial parks that have been built out over the years. And what this community, again, for 20 plus years, did a really good job of is they retain a certain amount of land and to market to end users themselves. They then sold off 5 acres here, 10 acres here, 20 acres here to a strategic developer or two that they required to build a minimum square footage of X. In a lot of cases, that was 50,000, 100,000. And then of recent, the last 2, 3, 4 years, I don't know if you can see my cursor, but back here in the north side of the development, this is an older Google Earth picture, so you can't see the buildings, but they built larger buildings, 300,000 square feet for one of them, 200,000 square feet for a couple of the others. That allowed the community, like I said, to be competitive for multiple types of projects, right? And then it led to success. So, for example, Trader Joe's, who you see down here in the bottom right, located on about 160 acres of the Stone Givens Industrial Park, and that project was in the neighborhood of 900 new jobs, $300 million of capital investment, a great project. They wouldn't have been able to land that project if they only had an existing building, right? Because the company needed to build something specific to themselves. However, moving forward, many of the companies that located in the northern part of the Henderson Industrial Park were speculative buildings built by a developer. Just a couple of examples to give you. Alta Alloys, they're a special processor of titanium, nickel alloys, and other super alloys. They relocated their headquarters and their manufacturing operation. They bought a 105,000 square foot speculative building. They paid for the building, and then they invested another 20 or $30 million in equipment and fit up, and they hired north of 50 people to work in that facility. Another example, that 300,000 square foot speculative building was bought by an energy storage company supplying, the electric vehicle market, Shinsung ST USA. They bought that facility, invested another $60 million, and are employing north of 100 people in that facility. So again, those are just a few examples of this one park. We could point out many others, but this is a really good example of a local industrial development authority that was willing to sell off some land to a speculative developer. That construction bred more construction, and now they have a really healthy industrial park. So I'll pause there, answer any questions. There's my disclaimer if you didn't hear me say it many times over. It's not a one size fits all approach. We're a big, again, believer, guys, in knowing who you are, and in some cases, holding your land specifically for that end user that it's well fitted for is an awesome approach, and we commend those that do that. But then also, I think there's cases where strategic partnerships with developers can likely lead to a faster success story. Happy to answer any questions if there are any.
So if you want to turn on your mics and answer a question, go for it. But also, if you want to type it in the chat, I'll read those out as well. So, right. Well,
Holly, I'd be happy to share some of the data that I shared, anecdotally and verbally as well, that you can distribute it to the group. And if anybody has questions moving forward after we get off the call, I'd be happy to answer them directly.
yeah, we can do that for sure. Well, it doesn't look like we have any questions, which is fine. But thank you for being here today, Lucas. It was a really interesting presentation. Um, and yeah, so just thank you for being here.
Well, thank you for having me, Holly. And again, thanks everybody for joining. I appreciate you taking time out of your day. And again, we'd be happy to answer any questions, and we hope to see some of you all in the future. Thank you very much.
Absolutely. All right. Thank you, everybody.
All right. Have a good one.
You too.